One of the benefits of fixing your mortgage is that you can protect yourself from future rate hikes and give you more stability. Let me explain how this works. When you fix your mortgage, you agree to pay a certain interest rate for a set period of time, usually 2, 3 or 5 years. This means that your monthly payments will stay the same until the end of the fixed term, regardless of what happens to the Bank of England base rate or the lender's standard variable rate, SVR. This can be a great advantage if you want to budget with certainty and avoid any nasty surprises. For example, if you have a £200,000 mortgage with a 25-year term and a 5% interest rate, your monthly payments would be £1. If the interest rate goes up by 1%, your payments would increase by £117 to £1, but if you have a fixed-rate mortgage, your payments would not change. On the other hand, if the interest rate goes down, you would not benefit from lower payments. You would also have to pay an early repayment charge, ERC, if you want to switch to a different deal before the end of the fixed term. This can be quite expensive, so make sure you check the terms and conditions of your mortgage before you sign up. Another thing to consider is that fixed-rate mortgages tend to have higher interest rates than variable-rate mortgages at the start. This is because lenders charge a premium for the security and stability that a fixed rate offers. So you might end up paying more in interest over the long term than if you had a variable-rate mortgage. However, this might not be the case if interest rates rise significantly in the future. According to Uswitch, the average standard variable rate, SVR, in the UK is 7.75%, while the average 2-year fixed-rate mortgage rate is 5.29%, based on 75% LTV. This means that if you have a variable-rate mortgage and the SVR goes up to 7.75%, you would pay much more in interest than if you had a fixed-rate mortgage at 5.29%. Of course, no one can predict what will happen to interest rates in the future. They depend on many factors, such as inflation, economic growth, supply and demand, and the decisions of the Bank of England's Monetary Policy Committee. The Bank of England raised its base rate from 0.1% to 0.25% in November 2022, and some experts expect further increases in. Therefore, fixing your mortgage can be a good way to protect yourself from potential rate hikes and give you more stability and peace of mind. However, you should also weigh up the costs and benefits of fixing your mortgage and compare different deals from different lenders to find the best one for your needs. One of the most important steps in saving money on your mortgage is to compare different deals and find the best one for your situation. But how do you do that? Here are some tips to help you. First, you need to work out what you can afford. Use a mortgage repayment calculator to find out how much your monthly payments would be at different interest rates and loan terms. You also need to factor in any fees and charges that come with the mortgage, such as arrangement fees, valuation fees, and legal fees. Second, you need to shop around. There are thousands of mortgage products available from a wide variety of lenders, covering the whole of the market. You can use online comparison tools to see what deals are out there and filter them by criteria such as interest rate, loan-to-value ratio, fixed or variable rate, and repayment type. Third, you need to be wary of extra interest. Some mortgages may seem attractive because they offer a low initial rate, but they may have a high standard variable rate, SVR, that kicks in after the introductory period ends. This means your payments could go up significantly in the future. You also need to check if there are any early repayment charges or exit fees if you want to switch to another deal before the end of the term. Fourth, you need to choose the right fixed term. Fixed-rate mortgages offer certainty and stability, as you know exactly how much you will pay each month for a set period of time. However, they may not always be the cheapest option, especially if interest rates fall during your fixed term. You also need to consider how long you want to fix your rate for. A longer fixed term may give you more peace of mind, but it may also limit your flexibility and incur higher fees. Fifth, you may want to use a mortgage broker. A mortgage broker is a professional who can search across the market and recommend the best deal for you based on your circumstances and preferences. They can also help you with the application process and negotiate with lenders on your behalf. However, you need to be aware that some brokers may charge a fee for their service, and some may not have access to all lenders or products. By following these tips, you can compare different mortgage deals and find the best one for your situation. This could help you save hundreds or even thousands of pounds over the lifetime of your mortgage.